What is up, guys? Welcome to day 13 already of Anomaly sequence. You may have thought that I was going to leave you there in the abyss, in the unknown. But no, we're actually going to continue exactly where we left off of from yesterday's video. I was thinking about going into a logic video, but I thought, no, that wouldn't make sense. Let's actually just continue exactly from this point onwards and build up a little bit more technical foundation. So you guys are in luck. 3 technical videos this week. That's a lot. I hope you guys are just, also digesting that knowledge in a concise manner, making sure that everything is a-okay and that you guys are also just working with the knowledge. But we talked about pretty much the running on liquidity aspect of things yesterday. We talked about the different ways that you can look at pretty much what you're looking at below, let's say, sell-side liquidity or buy-side liquidity. And now what we're going to be doing is the opposite, right? So we talked about potential liquidity grabs forming, candle closes forming, candle body close plus open forming below and above these levels. What we're going to be talking about now is pretty much everything that happens above and the infamous shift, right? We're not going to be introduced into the shift just yet, but I want to kind of portray what you're going to be looking at, right? What makes most sense. So we've combined pretty much the concept that we're using, the 3 playbook, the 3 different type of plays you have from your playbook, right? From arrays into highs and lows, right? And from highs and lows into arrays, right? Whether that's H4, H1, this kind of being your intermediary time frame, being flow, right? H1, H4, all that good stuff. And this kind of occurring on your lower time frames, whether that's M15, M5, M30. Don't really use M30 a lot, but anything that's fractal below H1. We'll be talking a lot about H1 later, how H1 acts as your middleman. So don't worry too much about that. But today's lesson, where we're gonna pretty much continue off of, is the continuation, right? So let's kind of get rid of this and let's kind of go into the details of what you're looking at when price comes back, right? One of 2 things that we really want to focus on is this distance, right? So we like to call this, some people call this a displacement, right? Don't worry about it too much, right? At the end of the day, you just want to make sure that this is kind of your room of execution, kind of where you can potentially get something happen, right? And my biggest tip that I say to everyone, all right, we're doing a different line here. My biggest tip that I can say, no, that's the one that I wanted. My biggest tip that I can give to everyone is this is your window of opportunity, right? I think that's the right wording that we want to have here. From this point onwards, you need to have your alert set. You need to have pretty much everything in line and have a predefined plan of what you're going to do. So let's just call this your window, right? This is your window of opportunity right here. And this is where you need to make a decision. My biggest tip with anything, I say that coincidentally, I talked to one of my students today as well. You need to close the gap between ideology and execution. And that's exactly what you want to be doing here. And that goes for all aspects of life as well. Whether you're like stuck with a dilemma or with anything, closing the gap between thinking about making a choice and making the choice is the most important thing that you can do, in my opinion. And the same goes with execution, right? Majority of the mistakes that you make in your execution is due to the fact that you're allowing yourself to think a little bit too much. Either your plan is not concise enough for you to, pull the trigger, or you lack confidence in your plan to execute when you should. Thus, deviating from the data, slipping up on your entry, and just giving it that space that it shouldn't have, right? So these small little things are super important when it comes to just understanding overall price action and kind of understanding where you should be executing. So this is your window of opportunity, right? There are a couple different things that you need to be looking at in your window of opportunity. With this example, and we're going to be sticking to these two examples. So the one where we are trading from an array into, let's say, highs and lows. Let's just make sure that that is clear as well. So let's say this is BSL levels. So, highs and lows. And here we are trading from, let's say, highs and lows into an array, right? Which is quite obvious to a higher time frame array as such, right? I think that's quite clear. So we're going to be using these two examples, and now we're going to take it one step further, and I want to introduce you to the concept of pretty much, we're using liquid and illiquid price action again. So in this window of opportunity, you want to be looking at a couple of things, right? You want to be looking at, is price aggressively displacing to the downside? In an illiquid manner. So in an illiquid manner, it entails it leaves behind imbalances, right? I think that's all something that we can understand just yet without having to go over the technical terminology just too much. Leaving behind an imbalance entails that there's a gap between three candles. Some of you may know it as a fair value gap. I've already kind of debunked the concept as to why I don't believe it should be called a fair value gap, but it is an imbalance in price. So in this case, you will have a bearish imbalance, right? That means that there is sell-side pressure of price displacing from this local high to the low, showcasing sell-side pressure, showcasing that there's an inefficiency that buyers cannot transact at this level, and that needs to be absorbed somewhere, right? And most likely that the sellers are trying to push price lower, trying to distribute price into that array. That could be an imbalance, that could be an order block, that could be a shift zone. Preferably imbalances and order blocks. Those are the two main kind of cornerstones of your technical arsenal and your technical understanding of price. One of them showcases inefficient price action, an imbalance, right? The other one showcases more of a liquid market condition, being an order block. An order block is an opposing candle in a direction, so an up candle in a downtrend, down candle in an uptrend, and it showcases fulfillment. It showcases on a lower time frame that we are transacting at that level and, being transactable, being liquid. So you see, are you making that connection yet? That's a very important connection. Imbalances, illiquid market, order block, liquid market, a combination of both. Boom, voila, you have a very nice POI, point of interest, right? That's where you can start plotting OTEs, optimal trade entries. That's where you start doing advanced stuff off beat, going on M12, M8 for your, BPR to really fine tune your stuff. But those are your bread and butter. That's your yin and yang, pretty much what it comes down to. And understanding when to use which ones is very important. So let's talk a little bit about this, right? In this example, we've got a higher time frame array here. We're going into that higher time frame array here, and we are trading away from that, targeting external potential buy side liquidity levels, external highs, areas where price was considered expensive. Right, this is where price was considered expensive. The demand for dollar will increase at these levels. If there's an aggressive mannerisms in that first move downwards, right, you need to ask yourself, hey, one of two things, right? It kind of leaves behind this imbalance. Okay, it leaves behind an inefficiency, and you need to ask yourself, what type of entry, do you want to be doing in that window of opportunity, right? It's not rocket science. In this case, there is a strong opposing price action. There's strong opposing order flow showcased in the inefficiency to the downside. You are going to be looking at how price reacts from that level, right? What you're going to be seeing is, if price then comes down like this, with an aggressive displacement, you want to make sure that you're not, there's a chance that it respects that array that it created, that bearish array that it created, and that, obviously continues lower. You don't want to get caught in those crossroads. You don't want to be the one to get caught in that. So then you're looking at some sort of additional rule. So if that happens, right, you see price come down, you see price pretty much create opposing arrays, you're going to be looking at, in this case, if it's an imbalance, you're going to be looking at prices transacting lower. You're going to be looking at the distal line, the one that's furthest away from price. Price will then react, right, to this potential imbalance. Ideally, what you want to see is price then kind of create and close above that imbalance and leave behind something else, right? Everything in this window of opportunity, what's so important is to see how price actually reacts to order flow. Instead of blindly having an entry pattern with just a market shift and call that an execution, you are spending a lot more time looking and validating and looking for those confirmations based off of order flow, right? So that is one example. What you're going to be looking for is pretty much price showcasing confirmations above that distal line. One of those confirmations could be a body close, a candle body close above that distal line. I know a couple of aggressive traders, I do that sometimes as well, that will market execute the moment that opposing arrays like this will get induced. You've got them getting induced, which means they're fully taken out of control. You can also, obviously, the safer option, and that's kind of where you start off with that, right? You start off with learning just the basics. The safest play for you to do, right? And that's what I guarantee will give you the most success is wait for the shift, confirm the shift, wait for a pullback, and then play. That's kind of what everyone is taught, especially in this type of trading style, which is good, which is great. There's nothing wrong with that. But I'm already kind of giving you guys and planting that seed in your head of the things that you could look at, right? Because textbook is you wait for the shift. You want there to be anything here, right? Like basic criteria is it doesn't matter what happens in the leg down, in the leg up. Preferably you see an order block being created here, leaving behind an imbalance, price to pull back, and then to go. Right, but I'm already giving you guys a little bit more insights as to what you can look at, what you can look for, especially in this scenario. So price trades into an array. You actually want to see aggressive movement into that array, right? So that means that, this move is aggressively trying to deliver into that area. And then ideally, right, you see some sort of exhaustion, right? But what you need to watch out with if you see those things occur. So price dropped into this array, higher time frame array, leaves behind another imbalance. You want to see price induce that imbalance. And then from there, boom, your window of opportunity is checked off and you can start accelerating and start implementing some sort of execution model. Whether that's a pullback, whether that's market execution, that's up to you, right? But at the end of the day, your invalidation point is clear. You've got your confirmation, right? You've got your ticks here off of your trading plan, and then boom, voila, you are targeting BSL levels, right? Not too difficult. I hope that makes sense. Here, the difference is a little bit, here, it's exactly the opposite. So when you don't have an array, right, you want to make sure that that new liquidity is being confirmed by showcasing imbalance on the way down, right? So what you don't want to see in this case is, at least you can see it, right? But I'm already giving you guys already such advanced filters. In this case, when it's just highs and lows, right? You don't want to see aggressive price action. You don't want to see illiquid price action above those highs and lows, right? Preferably, you want to see that come back after we've tapped into that passive liquidity. Because remember, above highs here, that's where the increase, where the demand for the dollar will increase. So ideally, we don't want to aggressively tap into that, right? Because that will then, entail that price needs to come back and then fill that aggression up. Likewise, with exactly what we said here. It's the same concept here. In this move, it's okay because we want that aggression to be distributed and pocketed. Here, we'd rather not see that. Just like here, where you can see that price could potentially follow through. At the end of the day, it comes down to the core concept of creating arrays and taking out opposing arrays, right? It's exactly the same here. But here, what you're looking at and what my golden tip could be is you want to see some form of arrays being created in the leg opposing of that run on liquidity of those highs. Okay, that's pretty much it. So in this area, you want to be seeing imbalances, order blocks, or shift zones. Very difficult to have a shift zone here. Ideally, you'd want to see one here, and that then gets respected, right? In that case. What it kind of comes down to is different filtrations to clarify your entry model, to clarify what you're looking at. And in the move downwards and upwards, to each scenario, there's preference with obviously seeing an imbalance in that case. But here you have the preference of seeing an imbalance being distributed into an array, and here you actually don't. Right, that's kind of the big difference. Aside from that, body closes here above the shift are very, very important. We're going to do a whole technical lesson maybe next week on market shifts, because I know that those are super confusing sometimes for you guys, especially lots of people get caught up by, they have the shift here and then it's like, oh, whoop-de-boo, boom. And then you try to enter this, but actually something like this happens, right? I mean, that's pretty much the entire lesson that I want to talk about that you see. Price kind of forms some sort of weak rollover here. No isolation of price, no isolation of liquidity, and then baits you out, actually trades your model here, and then boom, voila, you get knacked. So that's something that you could look at as well. At the end of the day, you'll see that that's kind of the core difference that I do with liquidity concepts in correlation to, let's say, ICT and SMC, is you look at the chart, you read the candlesticks candle by candle. It's not that difficult. Obviously, not many of you have the luxury to do that, and that's why I want to give you guys the tools already, that your arsenal is up to date with everything that you need. And then from there, that you start looking into how to implement that best with your own schedule and your own, let's say, obligations and your own freedom, right? So that was one thing. I don't want to hint too much at what I want to cover in that lesson just yet. I'm kind of deviating away from the point here. I'm trying to figure out if there's anything else that I can say. But this is very, very clear. In this distance, you want to see arrays. Here, you want to see, price respected. Ideally, you're always confirming order flow. You're always seeing whether or not price is creating some sort of arrays in your anticipated direction and taking out opposing arrays. It's so simple. And again, the lower the time frame you go, the more refinement you need to do. Don't work backwards. Just because you see a market shift on M5 with a bullish order block, but there's fuck all on M15, don't do it. That's the mistake that I'm currently in, is that I'm too excited on M5 the whole time. And I'm making that mistake over and over and over again. Fortunately, my management is very much in control, but it's unfortunate. It's sloppy performance, right? And that's the biggest mistake that I see you guys do, right? Where, you'll especially, let's say, Asia range traders, right? Asia range low gets taken out. Boom, next opposing market shift with an M3 imbalance, you're in. Yes, that's your silver bullet, right? But at the end of the day, you can make that so much better, right? Liquidity concepts, I wouldn't say is a contradiction to SMC and ICT. It is an amplification. I think that's the best way to put it, because I'm not here to as I said in the initiation, I'm not here to, boast and toot my own horn a lot, but I'm also here to just help you understand what the differences are and how my understanding of the market can give you that extra clarity. It will cost you a lot more time and effort to understand, but I'm telling you that clarity will give you so much zen and peace in your trading as well. So don't worry too much about it. You have your entry pattern. What we're pretty much doing is adding a filter process on that entry pattern, right? You're looking at where you need to look for arrays. This is your simple E1, right? And E2 is your continuation, right? You're not running liquidity because you can't run liquidity here. You can isolate that liquidity. That's super simple, something like this, and then, play some sort of like bear trap and then play the flip on that. advanced stuff, don't worry about it. That was just to kind of like give you that dopamine of what is to come. But this is your bread and butter, right? This is where, you know, every movement starts off with running into some form of array, running into at least every high probability move, right? You know, scenario A plus and scenario A will be one of these two, right? The one where it's just highs and lows into highs and lows, that's obviously where it becomes a little bit more complicated and where you're more range bound, which is not impossible to navigate, but it's just harder. And I hope that you understand the logical reasoning as to why, because you don't have, you're missing information, right? Arrays are information. Arrays are pieces of the puzzle that the chart is trying to tell you. Not that it's like speaking to us, but you get what I mean. It's pieces of the puzzle that just give you information, that give you variables, that give you something that you can navigate, use the intricacies, and kind of solve the puzzle of that day. That's what you get with arrays. The more arrays you have, the more information that you have, right? And if you're lacking arrays, then you're just lacking information, and you are putting yourself in a perspective where you are just more and more against, let's say, high probability outcomes and the route that you should be taking. So I hope that that suffices for a little bit more deeper understanding as to continuation of the shift, continuation of the move. Right, we talked about what we're looking at, running liquidity, and this is pretty much just the continuation of that. So I'll see you guys tomorrow with the next one.